You pay your credit card in full, open your credit app, and your utilization is still high. Your face says, "I literally paid you." The credit report says, "That is not what I heard." This usually is not a conspiracy. It is a timing problem. Your payment due date and the date your card issuer reports account information are not necessarily the same date. Once you understand that difference, credit utilization becomes much less mysterious. Credit utilization is the share of your revolving credit limit shown as being used. If one card has a $500 limit and the reported balance is $250, that card shows 50% utilization. The confusion starts when your banking app says one number, your statement says another, and your credit report seems to be living in a different timeline. That can lead people to carry a balance, pay unnecessary interest, or treat 30% like a trap door that instantly destroys a score. None of those reactions fixes the real issue. What balance was reported, and when? Credit card issuers commonly report account activity around the end of a monthly billing cycle. The balance on your credit report, therefore, often resembles the balance from your latest statement. Reporting schedules vary by lender, however, and an issuer may report to different bureaus at different times. That means paying by the due date can protect you from being late, but the statement balance may already have been reported before that payment arrived. Paying on time and controlling the balance that gets reported are related goals, not identical deadlines. Scoring models can consider how much revolving credit you are using. They may look at utilization on an individual card and across your revolving accounts. Using a large share of available credit can indicate greater risk, but no responsible source can tell you that crossing 1% will change every person's score by a specific number of points. The Consumer Financial Protection Bureau notes that some experts advise using no more than 30% of total limits, while others recommend less than 10%. Treat those figures as risk management guidance, not a magic cliff. Lower reported balances generally leave more room and reduce the chance that a normal purchase suddenly creates high utilization. Most important, you do not need to carry debt or pay interest to prove you can use credit. Carrying part of a balance from month to month does not unlock a secret scoring bonus. Imagine Jordan has one card with a $500 limit. During the month, the balance reaches $300. That is 60% of the limit. Jordan pays the full $300 by the payment due date, so the account is not late. But suppose the issuer created the statement and reported the $300 balance a week before the due date. Jordan's credit report may temporarily show 60% utilization even after the bank app shows 0. If Jordan wants a lower balance to be reported in a future cycle, Jordan could make an extra payment before the statement closes. The exact reporting date depends on the issuer, so Jordan can review prior statements or ask the issuer when it typically reports. Jordan should still pay at least the required amount by the due date and should not risk overdrawing a bank account merely to chase a utilization number. If only $25 is reported on the same $500 limit, the displayed utilization is 5%. That example explains the math. It does not promise a particular score change or approval result. First, open your latest credit card statement and identify the statement closing date, payment due date, statement balance, and credit limit. Second, calculate the utilization shown by that balance, reported balance, credit limit. 100. Third, compare the statement with your credit report. The report may lag behind your live banking balance because account data is not transmitted continuously. Fourth, if a major purchase caused an unusually high balance, consider paying part of it before the next statement closes. Only if doing so fits your budget. Then pay the statement according to its terms and on time. Finally, Ask the issuer about its reporting schedule if the timing remains unclear. Do not assume every card follows the same schedule. Mistake 1 is confusing the statement closing date with the payment due date. One usually captures the billing cycle. The other is the deadline for the required payment. Mistake 2 is believing that 30% is a universal pass or fail line. Utilization is one part of a larger credit profile, and scoring effects vary. Mistake 3 is carrying a balance and paying interest because it supposedly builds credit faster. It does not create a special scoring reward. Mistake 4 is obsessively making payments without protecting the checking account used to fund them. A low reported balance is not worth an overdraft or a missed essential expense. Mistake 5 is checking a score immediately after a payment and expecting an instant update. The issuer generally must send new account information before a credit report can reflect it. Credit utilization uses the balance reported to the credit bureaus, not necessarily the live balance in your banking app. Reporting commonly happens around the end of a billing cycle, but the exact schedule varies by issuer. Pay on time, preferably in full when your account terms and budget allow. If you need a lower balance reported, learn your card's cycle and consider paying before the statement closes. Use percentage guidelines as guardrails, not promises. Check one statement today and find these 4 items: limit, statement balance, closing date, and due date. If the dates finally make sense, subscribe to Credit Unlocked. The next video will explain why a credit score can drop even when you think you did everything right. This video is for general educational purposes and is not personalized financial, legal, or credit advice. Issuer reporting practices, scoring models, account terms, and individual results vary. Confirm dates and terms directly with your card issuer. This video contains no affiliate links or paid product recommendations.